Good afternoon. You're watching Businessworld live here on One News. I'm Delos Santos. Let's first have a look at how the local bourse closed today, Friday. It's a two-day losing streak here for local stocks as Philippine shares traded in the negative for most of Friday's session. The main index was on track to actually end flat, but a last-minute sell-off pulled shares lower by 0.5% to 6,786. That retreat happened even as foreign investors bagged local stocks for the fifth straight day with net purchases totaling 631 million pesos. This profit taking, says Japhet and Chanko of those stocks, may point to a doji candle or a reversal of the rally we saw the past days. That's due to uncertainties over the Fed as well as the upcoming quarantine restriction once the current classifications expire by August 31st. Now, given that we're still currently seeing a surge in cases, a status quo of MECQ, at least in NCR, might result in a negative reaction next week, according to Tanchanko. Of course, we can't cap off this week's market look without talking about the week's outperformers in Globe and PLDT, both of which have soared tremendously, at least over the past two sessions. But that's not the case today, as Globe shares declined while PLDT had a more muted climb this Friday. And it's been overseas funds which have been boosting Globe, which rose more than 30% this week. Tanchanko says month to date, Globe has been the highest in terms of net foreign buying. Both stocks getting bought in expectations that the pandemic will further escalate demand for data and mobile digital services, and that the government will be easing restrictions on foreign ownership of shares, especially for telcos and utilities. But like what we mentioned earlier, diverging paths for the two stocks today. PLDT on the top chart, represented by the green line, is higher by 1.25% to 1,467, while Globe got dumped for the first time in six sessions, declining by 3.4% to 2,848. But if there's any big gainer today outside the main gauge, it would have to be leisure and resorts. The stock climbed today as much as 14% in the early goings of the session. That's after President Duterte last night said that he is now okay for casinos to operate in Boracay in order to raise government funds. Now recall that the president himself imposed a moratorium on casinos on the island destination 3 years ago as Boracay was undergoing rehabilitation. Now, why is this pushing shares of leisure and resorts higher? Well, the resort operator has a project with Galaxy Entertainment for a casino in Boracay. This was revealed as early as 2018. Back then, they said they haven't abandoned the venture yet, despite the president's moratorium. As you can see, leisure and resorts pared back that 14% gain earlier, but still ended higher by 8.1% to a peso and 60 centavos apiece. Here are other headlines we're keeping our eyes on. PAGCOR expects gambling operations to recover to pre-pandemic levels by the latter part of 2022. The casino regulator says this is assuming borders are already open to foreign tourists by the time. The Philippine Star reports that for the meantime, PAGCOR is relying on digital channels, including online sabong and pogos, to generate income. PAGCOR sees revenues this year between 35 to 38 billion pesos from at least 36 billion pesos in 2020. Meanwhile, during the agency's budget hearing at the lower house this afternoon, PAGCOR said the ban on new casino operations imposed more than 3 years ago has been lifted by President Duterte. Domingo also said nearly half of POGOs in the Philippines have moved to Cambodia, Vietnam, and Laos due to Philippine tax laws on POGOs. Now, the government is looking to borrow over 10 trillion pesos this year until 2024 to bridge a widening fiscal deficit. The total 10 trillion borrowing will be divided in tranches with 3 trillion pesos set this year. This pushes the country's debt to GDP ratio around the recommended international threshold of 60% during the period. The government also wants to raise 250 billion pesos from the domestic market by September. The Bureau of Treasury set a 75 billion peso borrowing program for T-bills and 175 billion pesos for treasury bonds. This is bigger than the 60 billion peso borrowing program set in August. Demand for government securities is still expected to continue next month with appetite for safe assets still present. Now, the government is shifting restrictions to a more granular approach as part of efforts to minimize economic losses amid the pandemic. The Interior Department says street with at least two cases have to be put on lockdown. Multiple cluster of infections within a barangay will also mean a lockdown. Food packs will be provided to affected households. Economic losses average 73 billion pesos per week under MECQ, slightly lower than the 144 billion peso lost under ECQ. Despite the hits, NEDA sees the economy returning to pre-pandemic level by end 2022 or early 2023. But with so much uncertainty, how likely is it really for the country to go back to pre-pandemic growth by the latter part of next year? Let's get insights from RCBC's Chief Economist, Mike Ricafort. Good afternoon, Sir Mike.
Hi, good afternoon, Jess, and to your viewers.
Okay, is Socioeconomic Planning Secretary Carl Kendrick Chua getting ahead of himself here? Can we really go back to pre-pandemic growth by the end of 2022? How encouraging are the signs so far this year to actually point to a recovery by next year?
Hi, Jess. When we did the math, actually, since early this year, since the first ECQ during the Holy Week, we already simulated how the GDP would perform in view of this the recent lockdowns and also the at least even the tighter restrictions that we're still facing now and maybe going forward. No, we have computed that. If GDP, if we set a figure to it, prior to COVID-19, it was 100 in 2019. Last year, when there was a contraction of almost 10%, GDP went down to 90% of 2019 levels. And we're now estimating a growth of between 4 to 5%, which has been our forecast for the past month, especially since the announcement of the 2-week ECQ that we just had. The GDP would go back to it would be around 95% of pre-COVID levels by the end of this year, and with a growth of about 6% next year, hopefully, but 2022 also an election year, we would already see a return to 100% of GDP. But then again, it would be a function of if there would still be risks of lockdowns down the road, because that's one of the biggest drags to the economy at the tune of, at least lately, it would be less than 0.5% of GDP per week. So imagine if that continues, or maybe if that would happen again, either sporadically or intermittently, later this year or even next year. So that could potentially still drag even the target of 4 to 5% GDP growth of this year, and maybe a growth of about 6% next year during the election year. So I think that's realistic. Uh, and of course, as a function of the lockdowns, if indeed there would still be that risk, we may see early part of 2023 to see a return. But definitely, that's for the whole economy. But if you have to take, if you look at the components, it would be kind of delayed for other businesses and industries, especially those that are still facing restrictions.
Mm-hmm. Now, much of that, of course, like what you mentioned, will depend really on lockdowns. You have NEDA, as we reported earlier, saying that MECQ would at least cost 73 billion pesos on a weekly basis. The government is now eyeing to veer away from regional lockdowns, this time favoring granular lockdowns as early as next month. Is this a more economically viable option?
Yeah, that's true. Yes, starting September, that's already the target for the granular lockdowns, meaning it would be down to the sitio or even barangay levels. That's already a departure from what we have been used to seeing, that at the municipal, city, provincial, or even regional levels. No? And hopefully that would indeed help the economy. Of course, there would be adjustments logistically. There's a need to also, of course, even the level of spending by the local governments, as may be supported by the national government, will also, there would be some adjustments to be made. Of course, there would be new guidelines as to, especially on areas that would be uh, adversely affected economically, because there would be stringent restrictions as to the movement of people in those specific areas. But definitely that's a welcome development in terms of mitigating the adverse impact on the economy. So, yeah, and other than that, of course, we're already nearing the important vaccination milestones, population protection. Hopefully, hopefully the 50 million mark, or if it would be adjusted slightly higher than that, we may already achieve that in about 2 months' time, because the rate right now is 10 million per month for vaccines administered. We're now at 31 million. So maybe give it 2 months, around October or November, we would already reach 50 million. And that's very important. And the herd immunity would be 70 million. Well, even if that would be adjusted higher due to the more contagious Delta variant, that could be already achieved as early as February to March, or maybe a little, maybe a few, maybe 1 to 2 months after, if indeed there would be adjustment. So those are very important measures, because that would, we're fighting a war. We're all waging this battle versus COVID-19, and that's one way to really be ahead with this unseen enemy, which is COVID-19, by way of increased vaccination. That would really better control and manage new cases, especially. So we would see in the coming months, in view of the hard lockdowns. Let's see if maybe next month, if there would already be also be some improvement in the new cases, and hopefully that would lead to justification, enable to further reopen the economy, and actually at least bring some form of normalcy into our lives, and hopefully solve a lot of the problems that we have been encountering since the pandemic, by way of this increased vaccination. And of course,
Now, of
yes, go
course,
ahead,
much of
Jess.
this also is pushing government to actually provide more fiscal room. In fact, like what we reported earlier, they're planning to borrow up to 10 trillion pesos until 2024. That's going to cause the debt to GDP ratio to balloon beyond the international threshold of 60%. Can we afford this?
Well, just for now, well, it's already controlled in the sense that we didn't really have a huge
Mm.
economic stimulus to start with. Well, in terms of, we have seen fiscal prudence in that respect, in the sense that expenditures have been controlled, especially on stimulus measures. Maybe other than the create law, which is considered to be the biggest stimulus measure, but nonetheless, that is still relatively comfortable.
Mm.
And hopefully, if things get better for the economy, if the GDP recovers further down the road, maybe for the next year or next 3 years, that would effectively increase the the GDP amount, the denominator, with which we compute the debt to GDP ratio, and hopefully that would help better manage the debt to GDP ratio at around 60% levels. If GDP
Mhm.
grows, of course, we have to be more patient with that. If it picks up further, that it would heal itself.
Mhm.
Maybe in the coming years. So, we've seen that almost 20 years ago.
Mhm. Of
Uh,
course.
yeah, from I think
Mhm.
we reached a high of 70% debt to
Mhm.
GDP levels, and there was a curing period when
Mhm.
GDP's growth was sustained at relatively higher levels, of around
That, of course, will depend really on how we are at least going to fare growth wise for the year and up to next year. Again, thank you very much for your time and your insights this afternoon, RCBC Chief Economist Mike Ricafort. Thank you, sir.
yeah. Thank you so much, Jess, and your viewers.
And those are the biggest stories this trading day, August 27, 2021. Catch Business World Live again Monday next week at 9:30 a.m. and 3:15 p.m. I'm Jess De Los Santos. We are One News. Mask on, wash hands, and stay safe, Philippines. Have a great weekend.